Yeah, thanks, Yashasri. On behalf of ICICI Securities, we welcome you all to Q2FY2023 results conference call of Regard Industries. We have with us senior management, represented by Mr. Mithun Chittilappilly, Managing Director, Mr. V. Ramachandran, Director and Chief Operating Officer, and Mr. Sudarshan Kasturi, Senior Vice President and Chief Financial Officer. Now I hand over the call to the management for their initial comments, and then we will open the floor for question and answer session. Thanks, and over to you, sir.
Thank you, Anirudh and ICICI Securities for hosting this call. A very warm welcome to everyone present today on the call. My best wishes for the festive season and wishing all of you a very prosperous year ahead. Thank you for joining us today to discuss the operating and financial performance of our company for the second quarter of FY23. We reported revenues of 980 crores in Q2, which represents 8.6% growth YOY and 16.6% CAGR over a 3-year period. It was fairly strong performance in YOY terms considering the high base of the corresponding quarter of last year. We witnessed some slowdown in consumer demand in the latter part of the quarter, but for which we would have seen a higher top line growth. On a segmental basis, the consumer durable segment reported strong growth in this quarter. The electronic segment has sustained its improved growth trajectory. The electrical segment was nearly flat due to price reduction in wires related to the copper prices. During the quarter, South and Non-South markets delivered YOY growth of 2.6% and 17.8% respectively. With consistent growth in Non-South markets, we have a more balanced geographic portfolio today. Contribution from Non-South regions rose to 42.7% of total revenue in Q2 FY23 from 39.4% in the last year. We are attaining scale in all the regions, and this will deliver benefits of operating leverage going forward. Gross margins for Q2 FY23 was at 29.2%, a drop of 210 basis points YOY. A&P spends were higher at 2.2% vis-a-vis 1.5% in Q2 FY22. As a result, EBITDA margin dropped to 7.4% from 10.5% last year. There was a 16 crore impact due to the copper price movement as we had to reduce selling prices while carrying higher cost inventory. But for this commodity related impact, we would have been close to 9% EBITDA margin for the quarter. Apart from the wires impact, there is continuing margin compression in durables due to pricing gaps compared to the input cost increases. We expect the gross margin in durables to improve from Q3 and to reach pre-COVID levels by the end of Q4. As we have shared before, our shift from outsourcing to in-house manufacturing impacts certain line items in the presentation as per accounting standards. As own manufacturing increases, there is a shift from material margin to other expenses line. Some volume related costs like freight and warranty are also classified under other expenses. This has a significant impact as the turnover has increased by 36% in the first half. We remain positive on improved margin performance going ahead. The recent softening of input prices meant that further price increases won't be required. As the existing inventory flows through the pipeline, the pricing gap will reduce. We expect the gross margin to revert to their normative levels by the end of the financial year. COVID-related disruptions had led us to hold higher inventory than normal. With risk of supply chain disruption diminishing, we intend to reduce our inventory holding. Due to lower sales than forecast during September, the inventory reduction has proceeded slower than anticipated. While it may take longer than planned, we will revert to normative stock levels in the coming months. With that, I conclude my opening comments. I would like to thank the team at ICICI Securities and Anirudh Joshi for hosting this call, and would like to request the moderator to open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Aditya Bhartia from Investec. Please go ahead.
Hi, good afternoon, sir. My first question is on the consumer durable vertical. When we look at some of the other companies in ECT and FMCG segments, their revenue growth is being fairly muted, while we managed to deliver 20% growth. So just want to understand, is growth in South also being really strong, or is growth being driven largely by non-South India segment?
So I think for V-Guard, the consumer durable segment has a lot of categories. Some categories that are faster growing than our peers. For example, we have kitchen appliances, which is small, and growing fast. We have a fan segment again that is small compared to some of the market leaders, but growing fast for us. So some of these would have contributed to higher growth as well.
And would it be possible for you to share, sir, how large the fan business could have become now? And given that we had made operational our kitchen fan facility some time back, how is that contributing to overall sales?
So we don't give out product-wise numbers. So once we, complete some milestones, we will give out some, information. But today, nothing to speak of.
Understood. And the question is related to margins of this particular vertical. How would gross margins be different from electronic segment? And we get to see our low EBIT margin per segment. Is that a reflection of lower gross margin, or is it overexposure to maybe economy segment, or is it just that overhead costs are currently not being properly absorbed because of smaller scale? But as we keep in scale, you again see margins heading towards high single digits and low double digits in the segment.
So in the consumer durable segment, both the fans and water heater business, the business in it, and their margins are impacted. But they are largely on account of, pricing gaps in the sense, the commodity prices have gone up to some degree, and the, players in the market, due to whatever reason, maybe hyper competition, poor season, whatever it is, are not passing on the full effect into the market. Okay. Second is, in the fan segment especially, there is also some flux in terms of changeover into new BE norms. So there has been some slowness in the market in that sense. I think the commodity prices have come down, and I think which also meant that no company has been taking any price increase since this April. Also, it is not required with the current level of commodity prices. So I think as soon as the older materials get consumed and we buy in fresh materials, raw materials, I think the gross margins should revert back to normal, and we expect this to happen in Q4. Regarding the gross margin percentage for consumer durables pre-COVID, Sudarshan, do you have the number? What are the normal gross margins for CD?
The CD overall gross margin is higher than the company average, which is when it was in steady state. Currently, we are going through a phase where there is a margin compression.
So I think, to answer the question, the CD margins were actually higher than the company average, gross margins pre-COVID.
Understood. So it's mainly about the absorption of some of the overhead costs. As the scales up on a steady basis, we can see the margin expansion.
Yes, that is happening, and also the commodity price inflation has not affected all the products in the same way. Something like a fan, this has been more sharper because aluminium is one of the key components, and aluminium prices have gone, very high because of the war situation.
And so the last question from my side is on the exchange which you just referred about. Are you expecting significant redesign to be happening just for these new norms become applicable? And once these norms become applicable, do you anticipate the market share movement within the channel?
I think the trade will be upstocking in the current quarter, not only for us but across brands, because they are brands will have to stop selling them before 31st December. So I think there is definitely going to be upstocking by the trade in this quarter. Going forward, I think market will normalize. I think every company has brought out products that are, when conforming with the BE norms. This is not a new thing. It's been in the works for at least 3 years. So we've all had adequate time to prepare to change over. So I don't, but of course, companies, who are better prepared with the BLDC products will have more, edge. Because the BLDC segment is fast growing, and it's growing very, very fast, as a sub-segment of the overall fan business.
Okay, understood. Thanks a lot.
Thank you. We have another question from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Yeah, hi, good evening, and season greetings to everybody at V-Guard. First question essentially was on industry, other than the company. The demand has been pretty much all over the place, similar expectations in first half. Rural, being more slower than urban market because of inflation. So I had one question on, after this festive season, let's say November, December and beyond. Do you think things look okay, or would you think jury is still out there, demand actually sustains at basic level? Especially, when customer pricing is still at the same level, there's hardly any price cuts being done by brands, and input costs are actually lower. So, any thoughts?
Yeah, Ram, you want to take this?
Yeah. So I think input costs, costs have come down, but also the inputs have not been fully, input correction has not been fully reflected in the market. So what you are witnessing today is, stress that you are witnessing is consequence of that. I think that stress is going to remain on one side. When it comes to demand, there are, okay, I think that, in the immediate, run up to the festive period, some stress in demand is observed, particularly 30-45 days. I mean, we found that, we followed up the plan. I think that, if we take a 3-year view of, how we have performed for the last quarter, then, we find that actually, we've grown at about, 15% or something like that. Even on a half-year level, or maybe, around 17%, if you just look at the quarter. I think one of the issues, when we are comparing with the previous period, COVID impact for the first quarter of last year is also, affecting how, the numbers look, when you make comparisons. Yeah? So I think at this point in time, it's difficult to say, how the demand will pan out next half. I think it's a fact to say that, there is a stress of demand in, rural markets, smaller town, or, entry-level products, right? So that definitely is there. That has been there for some time now. Actually, they're actually from the early stage of the commodity run-up, and, it was initially reflecting in stress, input cost increases. So, even the companies were stressed in terms of margins on entry-level products because of the inability of the margins to drop. This challenge is there. This challenge will continue for some time. I think business has been living with this challenge for the last 12 to 18 months. So, in that respect, it's a continuing challenge. But I think there are some other factors like, the transition to new energy standards, is causing some destocking in fans. The price reductions in wire is causing some reduction in, wire inventory and so on and so forth. So these kind of factors are also playing out because trade is downstocking. I think, some of the slowness that we are seeing is a combination of these two factors also, where there is some short-term destocking happening in the channels, so that, they are able to adjust to any potential risks, right, arising out of this energy change or, any, downward impact in copper. So this is fundamentally reflected in the wire business, right? So, but yes, there is some stress, because we found it consumer durable and all,
the planned selling that we wanted to do did not happen. So there is some stress, in terms of sell out. But I think we will know better in the upcoming 2 months, when once the post-Diwali, offtakes are replenished by trade.
Got it, Ram. And secondly, on gross margins, now South and non-South is almost now becoming equal. So there is, rather actually we should not even discuss, regional sales henceforth. But, and gross margin difference is still there, but pricing is still lower in northern market for V-Guard, and how is that moving?
Yeah, Sudarshan? There's no difference between gross margin in South and non-South. Pricing is also uniform. So there's nothing really to call out.
I think for the last maybe 3 years or something like that, this is the case. So it's almost been 3-4 years we have had a uniform pricing.
Got it. That helps. Thank you so much, and happy Diwali to everybody. Thank you.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Sonali Sargaonkar from Jefferies India. Please go ahead.
So thank you for the opportunity. So my first question is regarding the demand in the industry right now. You did mention that the latter half of Q2 saw slower demand. So what are the initial demand trends that you have witnessed in the festive season, and what is the level of channel inventory right now across most of your product categories?
So Ram, you want to take this?
Yes. So I think, wire sales have been slower because of downstream trade. As wire copper prices have been coming down, they've been adjusting their inventory to adjust risk. We've also seen a bit of pressure on fans. So fans also, the trade is preparing for, the post-BE scenario. So they are slower to upstock. And they have brought upstock even on, growing categories like BLDC because they want to correct their overall, portfolio, and they are focusing more on liquidating, fans which will fall in line with the old energy standards. Okay? So I think these are 2 areas. I think water heater sales also, our fan has been more bullish, but what we are seeing, although it's good growth, but it's less than what what we would have to. So I think these are some areas, where, we have seen, I would say like, some stress point. But having said that, I think there is also an issue of, appreciation of the subject because, when we are making, for example, we've grown at, close to about 8.5%, and there is like 8.8%. And if the wire prices were constant, this would be, more like a, 11.5% kind of growth, which may not be bad because the base period was a higher base as there was shift of sales to Q1 to Q2. So I think there's a bit of maybe, we all anticipated much higher sales. But definitely some slowness is observed in some of these categories. It may also be because, this short period and all that was coming, just before the month end, right? So, as far as, channel inventory is concerned, yes, there is, that is also reflecting some, increase in terms of number of days. That's also one of the factors why, we still that there may be a slowdown in the last 45 days. So there is some increase of channel inventory. So it's not alarming or anything, but we are seeing that there is some increase in channel inventory.
Understand. Then what about real estate demand? I mean, you have 2 categories.
Real estate demand is also lower. Yeah. But that is a bit difficult to derive because, there may be some amount of, because, in our portfolio, we primarily need to look at wire, switches and switchgear. Okay? We are not a very player from an industry standpoint of switches and switchgear, and most of our switches and switchgear sale is, primarily retail. Yeah? Yes, wire is also retail, but, we have a reasonably large wire business, and yes, there is a bit of, what I would say, slowness we're finding, collections are getting a bit slow, the rotation of money is getting a bit slow. These are some of the indicators, which are contributing to making us feel, right? There may be some slowness in the last 30 days of last quarter. Yeah?
Got it, sir. So my second question is on price hikes. Last quarter or this quarter that we are in, have you taken any notable price hikes also in fans with the new BEE norms? How much price hikes do you expect?
Ram, during, if you're asking about price movements during the current quarter, prices have largely been flat compared to.
Yeah, there has been no price increase except for wire. Yeah, there has been no price increase per se, between Q1 and Q2. I think in wire there will be a drop of prices. Other than that, there is no change. BE, I think they are primarily going to be new models. So I think in the entry segment, the price increases are about 5%, if I'm not mistaken. Ram, you want to clarify?
Yeah, it's that way. So I think fundamentally, what will happen is that the newer models will get launched. So it will not represent an increase in price per se. The newer models will probably be positioned at higher prices, anywhere between 5 to 8%, depending on, the segment that we are talking about, right?
And how much percentage or rather how much portfolio of our fans is into premium fans right now?
Okay. I think mid and premium would be about 40%, I think. Ram?
Yeah, a bit more than that, Mr. The last year and a half, I think, the sales in entry level have been, less relatively. So I think it probably would be, over 50% now. 40 to 50%. 40 to 50% you can take it.
And last question from my side. Could you give us the broader idea of volume versus value mix in cables and wires this quarter?
Okay, this quarter. Okay, can we share that offline? We'll share that offline, Sonali.
Sure. Thank you, sir.
Thank you. We have our next question from the line of Nirav Vasa from Anand Rathi. Please go ahead.
Hello, sir, and thank you very much for the opportunity. Sir, just wanted to check what is the kind of growth prospect that we are seeing in our core product category of stabilizers, and how do you see that for this end of the year? And the second question will be pertaining to the range and reach expansion. So we are already south and non-south, we are favorably placed. What would be our next steps with regards to expansion of our channel base?
So, I think I'll address the second question first. I think you're basically looking at, what are our plans for channel expansion. I think, yes, I think, the mix of, south and non-south is favorably progressing. But I think, we probably are in, what I would say, we have probably covered 60-65% of the journey. I think, we still have, significant scope non-south to increase reach also and improve expansion also. I think, there is, the throughput per counter and, the reach, right? I think, the reach we will continue to, expand, at the rate of, around 5 to 6,000 outlets every year. We will continue to add as far as non-south is concerned and as far as the distribution reach is concerned. Additionally, we are increasing focus on, organized retail. We have been weaker in organized retail, and this is an area that, we will be focusing on in the next 2 to 3 years, and that will also represent, of what I would say, lever and opportunity for us to expand our business. So I think these are, two broad levers that we'll be focusing on 5 to 6,000, counters annually, as we have been doing over the last 6 years. And, improving our width and depth in organized retail. That's a lot more easier relatively in terms of access, compared to, retail expansion. I think your first question, forgetting.
Growth in stabilizers.
Yeah, I think, the stabilizer growth,
See, stabilizer growth has been in the region of around, if you look at our electronics growth, for example, right, it's in the region of around 7 odd %, right? If you look at 4-year CAGR, for electronics as a segment. It's of course, lagging the growth in electrical and consumer durables. Right? That being said, I think, that's part of our growth trajectory. And if you look at our 3-year half-yearly growth of about, 3-year CAGR of 15% that we have achieved, the electrical and consumer durable segments are segments that we are focusing to drive. Right? Just one more point. I think one of the challenges with the electronic segment and the stabilizer in particular, I think, COVID stress has, impacted at least, I would say 2 of them, 3 or 4 quarters over the last 2 years, right? Because COVID actually has come, come in and, impacted in some months. So, I think a couple of years of, free and open summer should give us a better sense of, how electronics, growth CAGR will move. Yeah.
Because we are a very strong player in the stabilizer market, can we target export markets using this product?
See, there is an export market and exports are certainly possible. The only thing is, each market is, having a different requirement. Yeah? And that requires a lot of, because there is a lot of competition, and particularly in, in Africa and those kind of markets, where this kind of product has some opportunity. There is a lot of what I would say competition from China also. Yeah. So we've chosen to focus our energy on the India market and, the Indian business fundamentally when it comes to stabilizers. And still V-Guard as a consumer brand in the electrical and consumer durable space, right? So that's more value creating, and that's why we have chosen this kind of path.
Thank you, sir.
Thank you. Reminder to participants to press star and 1 to ask a question. We have our next question from the line of Deepak Saha from Savard. Please go ahead.
Thank you for the opportunity and participation to everyone at V-Guard. My first question is regarding in terms of high cost inventory that you all are sitting with. So the amount of high cost inventory you're sitting with compared to the current level of copper prices, is it still significant or almost gone? If you can share some color on that front.
So on copper, the issue is gone. It was during July and half of August we were having higher cost inventory. Once that has gone out, wires margins are back to normal in September. So it's not an issue with wires anymore.
Okay. And on the aluminum front?
Aluminum. So I think it's primarily in the case of fans, where we are holding some high cost inventory, but I think by end of Q3, even that will get exhausted. So we are not, we are not too concerned about that. But yes, that would mean that the margin improvement in fan will take some more time to,
Okay. And as the commodity prices kind of stabilize at this level, do you think by the end of this year, we'll be able to kind of reach the similar EBITDA margin level near to 9.5 or where we ended last year, given the operational efficiencies that we have? Or it will again take some time for the operation efficiencies to reflect in terms of margin, EBITDA margin level?
I think yes, given the current cost environment and prices do remain where they are, I think by end of Q4 we should hit the kind of gross margin that we had before all this inflation started. So that's our expectation as well.
And my last question is on the electrical point of view, sharing some idea. About the demand, is there any softness in terms of demand on the electrical part, given the growth that's recorded on YY basis, or it's a high base impact that we're having on the electrical front?
No, electrical is primarily for us. If you look at electrical, it's the largest component is wires. So whenever there is a copper price decrease, the trade destocks So when the trade destocks, obviously the sales will slow down. And that will, the trade will wait to see bottoming out of copper before they restart stocking. That's the kind of thing we are seeing. So it may not be fully, explaining, it is probably more to do with the pricing environment rather than the demand environment.
And last one, sir, as you said, by the end of Q4, we'll be able to get back to those high level of margins. So does it mean that we'll get back to this level of margins, will not end at the close to somewhere where we ended last year, and in terms of full year basis?
So I don't want to give out any specific numbers, but what we believe and hope is that, given the, inventory we are holding, given the current price environment and given the pricing in the market and the overall, our expectation is that by somewhere in Q4, we should start to be in the gross margin levels, which, we were before before COVID. I think in COVID, what happened is there was a expansion of gross margin also. Because initially the copper prices, the commodity prices came down, then it shot up. So I think the good way to, what we will look at is probably pre-COVID, margin numbers.
Thank you, sir. That was helpful. And all the best for the second half of the year. Thank you.
Thank you. We have our next question from the line of Concall from ICICI Securities. Please go ahead.
Thank you for the opportunity, sir. So my first question is regarding our inventory days. You highlighted that inventory days will get normalized. So what will be the target range where we should expect inventory days going forward?
We normally operate at about 70 to 75 days of inventory. Currently, we are holding more than that. And, we would want to come back to those levels. We are probably having maybe 20 days more inventory than, what we used to hold, before COVID, during which time we decided to increase safety stocks and stuff like that. So we wanted to reduce it, significantly by the end of this quarter, but like Ram mentioned, the sales have been less than what we anticipated, so we're still carrying some inventory. And we hope by end of Q3 we can reduce, inventory by, 15 to 20 days.
Okay. Sir, next is regarding the, as an earlier person also asked about the distribution strength in non-south states. Can you quantify your south versus non-south distribution strength as of now?
You are talking about the number, Ram. I don't know whether we have the exact numbers with us.
Listen, I don't have ready numbers of.
Yeah. We'll share that offline. The retailer numbers we can share it offline. But I think one important point to understand also is it's simply not number, it's also extraction. So, we can try and sell it to 100 dealers in a town, or we can try and sell to 20 dealers in a town with, 30% share of this counter, which will be more meaningful. So both these are important.
Okay. So apart from that, the company has started its roadmap activity. Does it need any new greenfield to fuel its growth in near term? And what are the CapEx plans for FY2023 and 2024?
So that's my CapEx projection.
Your first part of the question you had, what did you talk about manufacturing activity?
You're talking about roadmap plant, right?
Yeah.
Can you repeat the question, the first part?
Sir, the company has started its roadmap activity and because of greenfield. So I wanted to ask, does it need any new greenfield CapEx in the near term to meet its growth targets?
So we are having 3 more plants under construction, and it will take another 18 months to complete them. And I think another 70, this year and next year, I think 20 crore of capex has been earmarked for that. Some part of the capex of this year has already been spent out of the 70 crore.
Okay. And so my last question is regarding the new categories in which V-Guard is entering, like water purifiers. Sir, what is the strategy for this new category? In what geography it has been launched? How has been the traction?
Ram, you want to take this?
Yeah. So, I think, we are still in, early stage of, the introduction and rollout of, the purifier business. We are still expanding our product portfolio and lineup to improve the, addressability. Our current focus is to, work through e-commerce, right? And, I would say, build, a decent business through e-commerce focus, and that should give a, give us comfort on what I would say the competitiveness of our mix, right? Based on the action that we are able to make in the category. After that, we would, open out into organized retail, and then only we will get into GT. So that's how we are going to travel with what we require, right? That was really very helpful, sir. Thank you.
Thank you. We have a next question from the line of Rusha from AC Choksi Share Brokers Private Limited. Please go ahead.
Thank you for the opportunity.
We are not able to hear you. There's a lot of background noise.
Am I audible now?
Yes, please go ahead.
I wanted to know the volume growth in
Sir, are you able to hear in?
Sorry, no, we're not able to hear. There is a lot of disturbance.
There's a lot of background noise. Can you move to a quieter place, please? Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have a question from Mr. Aniruddha Sochi from ICICI Securities. Please go ahead.
Yes, two questions. One, how do you see the kitchen appliances growth panning out, and how is the penetration of kitchen appliances in South India as well as non-South India? And do you see any competitive intensity with the acquisition of Butterfly? Also, the second question is on the effective tax rate. As the production at the unit ramps up, how do you see the effective tax rates planning for FY24 and FY25? Yeah, that's it from my side.
Okay. So I think the kitchen appliances part, Ram, you want to take it?
Yeah. The kitchen appliances business is currently, mostly focused in South for us. Yeah, it's, it's growing much faster than the overall company growth. But still, we are in very early stages. We have the, we have established the product base, the supply chain, yeah, and the competitiveness of our categories. Yeah. We are currently, working on, putting in place a manufacturing facility to come up in the next 12 to 18 months, so that, our competitiveness in this category can be enhanced. That's our, near-term focus, and we believe doing so will help us to, improve our ability to grow this category and business effectively. Yeah. That's on kitchen. I think, Mithun, you want to take this second part?
Yeah. Regarding Butterfly, I think, we don't want to make any comments on competitors, so I'll skip that. Regarding ETR, Sudarshan?
Yeah, the new manufacturing entity will have a tax rate of 15%. So there is some amount of tax benefit that will come from there. FY24 is going to be a ramp-up period, so we may not see very significant reduction. But in FY25, we can expect 2% ETR benefits coming from there.
Okay, sure, sir. Understood. And last question, any change in market share that we have noticed in our categories in last 6 months or so?
No, I think market share is not to be, seen on a quarterly basis. When we complete the year, then we shall talk about it. Maybe it's too premature to talk about market share.
Okay. Sure, sir. Yeah.
Thank you. Ladies and gentlemen, to ask a question, please press star and one. We have a next question from the line of Aniket Mittal from SBI Mutual Fund. Please go ahead.
Yes, thank you for the opportunity. Just a few questions. Firstly, I wanted to understand the margin trajectory a bit better. So you're guiding for the margins to recover by 4Q to the pre-COVID levels. Just wanted to understand what would this be dependent on? Is this largely a function of the high cost inventory being import, or are there certain amount of volume pickup or price hikes that are basically building this in?
So I think our gross margins are off by between 2.5% to 3% from where should we be, from normative levels. And we believe that the current level of commodity price offers us that, reduction, provided, the current high value, high cost inventory sells out and we are purchasing, materials at today's prices. So I think this entire process will take four odd months. When the supply chain will, keep liquidating the current inventory and buying raw material and, manufacturing goods at the current prices and, going forward. So that's going to be the main reason for the margins to come back to normal.
And this would, I assuming, would largely be on the buyer's business and the fans one, is what you're...
Wire is more faster. This will be primarily on the consumer durable business, where we are having more stress. Mostly consumer durable and maybe even inverter battery. A little bit of inverter battery, but I think it's mostly consumer durable business. The wire business, this impact, we don't carry much inventory, so, we would have already, the reduction of prices also immediate, and the consumption of new materials will also be immediate. So it happens more faster in, categories like wires.
So the recovery has to happen in electronics and consumer durable segments. The electrical segment will come back, faster.
Okay, that's helpful. The second question was, in one of your remarks, you mentioned that the growth in water heaters has been less than what you would have anticipated in the quarter. So just wanted to get more light on how the marketing is sort of panning out and why has the growth not come in this quarter for you?
See, water heater business, we had lost some market share, a couple of years back. So last year and this year, we plan to grow more aggressively, than, we have been growing to. I mean, of course, we have regained all the market share that we have lost, but we have to, we still have a year of lost year that we need to catch up on. In that sense, yes, our growth has been less than what we anticipated, but we probably have grown still faster than the market.
Mr. Mittal?
Yes.
Does that answer your question?
Yeah, so I just had just one more question actually, and this is to understand a bit better on the growth in certain individual categories. So if I look at, let's say, the ECD segment of fans, water heaters, and the electrical segment of pumps and wires, could you give me a broad understanding of what's been the YOY growth for this quarter and in the first half?
No, we don't give out product-wise numbers.
Okay. And just one last question. So we had acquired the Simon brand on the switches front. I think we're fairly positive on switches and switchgears as a segment. So just wanted to understand what is the traction that we are seeing within this segment, and how are we planning to merge the Simon brand in our portfolio?
Okay, Ram, you want to take it?
Yeah. So I think we are still in the acquisition process, and this is not complete yet, since it's going to be a merger. This is a court the entity-driven process, and it will take another couple of months maybe for the process to be complete and for the entity to change hands. So I think, this is, this is not materialized on the ground, in terms of initiatives. Right? So the merger is in progress, and we should touch back on this, sometime in next quarter.
So by next quarter is when we would expect it to get
Yeah.
Thank you. Those were my questions.
Thank you. We have another question from the line of Keyur from ICICI Prudential Life Insurance. Please go ahead.
Thank you. I think the question is on the overall profitability or say operating profitability. As you mentioned that as high cost inventory is consumed, at current prices will go back to pre-COVID levels gross margin. Now, if I look at pre-COVID gross margins, which we had in those years, but from that level, our sales levels have gone up. So in that backdrop, how should we think about our operating margins? And just to add another layer, is as you hinted that there is some slowdown in the demand, and you are seeing competitiveness in pricing as well. So do you see any risk to this increase in gross margin as people go for volumes over profitability to push the demand? So how do you see these equations playing out and their impact on the operating margins of the company?
I think today, we have a portfolio of products, and when you see it as a portfolio, yes, this particular issue is there in maybe some of the categories, but not in all. But as a company, we don't foresee that much of an issue. So like I said, we are off by between 2 to 3% in gross margin on a company level. And the price reduction since May has been, almost in that same range. So that is what gives us the, belief that it is possible to go back to that margin. We will have this all the hyper competitiveness happening either in category or category B, but it doesn't happen across. So I think that, this may not be an entire portfolio problem, but yes, in individual categories, this issue may be there. But we also find that these are transient issues, and I think with it, after some time, people do understand that cutting prices is a zero-sum game because everyone else will also do the same, and then finally, there is very little evidence that someone will actually gain market share by cutting prices. So I think once that realization happens, we have seen that, these things are transient and they will, move on. For example, about 4 years back, 5 years back, kitchen appliances was a very hyper-competitive category. Then after 5 years, we found it to, have mellowed down. Then, a few years back, water heater was in the same position. Today, we are seeing it mellowing down. So I think this will keep happening. But I think as a company or a portfolio, we don't see it as a huge risk.
Okay. Just to elaborate this question, so when we talk about the pre-COVID gross margin, but from those levels are still at much higher level, so should it boil down to much higher EBITDA margins also as we improve gross margin?
I think it's not that high. If you look at a 3-year CAGR, we are talking about 15%. It's not, so because 3 years have also passed after COVID has started. So I think we should also look at it from that lens. Time has also passed. Yes, there has been some increase in prices, but it has been only maybe for, one, year. There has been an increase in prices. And if you look at the previous years, the price increases were very minimal because commodity prices have remained flat, since maybe 2016 or 17.
Yeah, just to add, to what Mithun said, right? See, we continue to grow at 6% per annum, but we are also a company which is continuously making investments. Right? So we've got into manufacturing, and by maybe another 12-18 months, we'll complete the manufacturing system expansion. Right? We are investing in talent, we are investing in technology, we are investing in the future. So I think, the other part is that, these investments will also come at a cost. So I think that's also you need to keep in mind, right? It's not just, let's say, this kind of growth will automatically translate into investment. There will be investments for the future. And those needs have become more stronger, right? Because of the changes in environment that have happened in the last 3 years. Yeah? So that also needs to factor in. So that's why it would be fair to say that the margin should be similar to what we were enjoying pre-COVID. Yeah.
Understood, sir. Thanks a lot and all the very best.
Thank you. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
I would like to thank ICICI Securities and Anirudh Joshi for hosting this call, and thank you all for participating in the call.
Thank you, sir. On behalf.
Please subscribe and press the bell icon to never miss another update. Please like, share and comment.